Hello students, I am Dr. Jyoti Arora, Assistant Professor in Commerce at GGDSD College, Khedi Gurna. In this video, we will discuss the topic of Reconstitution of Partnership Firm. Reconstitution means working again on the terms and conditions of the partnership. If we talk about the modes of the reconstitution of partnership firm, there are four methods or modes of reconstitution. First is when the existing partners agree that they want to make changes in the present profit sharing ratio, then the firm is reconstituted in this case. Second case of reconstitution is when a new partner is admitted to the firm. Third case is when an existing partner retires or is expelled or becomes insolvent, then also partnership firm is reconstituted. And the last case is the death of a partner. Now, in this video, we will study the first case, that is the admission of a new partner in the firm. So we start with admission of a new partner. First, we discuss the meaning of admission. Admission in the partnership firm means when a new partner is admitted to the firm. It happens only with the consent of all the existing partners, and with this, the old partnership deed ceases to exist and the new deed comes into the existence. Now, what is the need of admission of partner in the firm? Why we can't run the business only with the old partners? So, reasons for this are: first, when we need more capital, then a partner is admitted to the partnership firm. Second, when we need the expertise that is lacking in the firm, then the new partner with required expertise is admitted. Third is when the new person is a reputed person and will add to the brand value of the firm. And the fourth case is that a new partner is also admitted to reduce the competition. When two partners join and become one, the competition is reduced. Now, coming to the accounting treatment in case of admission, we will see how the effect of admission is shown in the books of accounts. So, in case of admission, there can be maximum 5 effects which are shown in the books of accounts. First is calculation of new profit sharing ratio and sacrificing ratio. Whenever a new partner is admitted, we calculate the sacrifice made by the old partners in favor of new partner and also the new profit sharing ratio. Second is revaluation of assets and liabilities and their accounting effect. Third is treatment of reserves and accumulated profits and losses at the time of admission of the new partner. Fourth is treatment of goodwill. And fifth effect is adjustment of capital on the basis of new profit sharing ratio. We will be discussing about all these 5 effects one by one. First of all, we will discuss the effect of admission on the profit sharing ratio of the partners. So, when a new partner joins, the old partners sacrifice a part of their share of profit in favor of new partner, and hence we need to calculate the new profit sharing ratio and sacrificing ratio. So for calculation of new profit sharing ratio and sacrificing ratio, there are different situations and we will study all these situations. The first case is when only the share of new partner is given in the question. So in this case, what we do is there are 3 steps to calculate the new profit sharing ratio in this case. First, we will assume the total profit of the firm to be 1. Now we will deduct the share of new partner from the total profit that we assumed 1. And the third step is the remaining profit will be distributed among the old partners in their old ratios. Let us understand it with an example. Amar and Akbar are partners in a firm sharing profits equally. They decide to admit a new partner, Anthony, and his share in profit is one third. Calculate the new profit sharing ratio. Let's apply the three steps that we discussed in last slide. So let the total profit be 1. Share of new partner Anthony given in the question is one third, and the remaining profit for old partners is 1 minus 1 by third is 2 by third. This 2/3 will be divided between Amar and Akbar in the ratio of 1:1. Share of Amar and Akbar each will be half of 2 by 3, that is 1 by 3, and the new profit sharing ratio of the three partners will be 1:1:1. Case 2 is when a new partner acquires his share of profit from the old partners in a particular ratio. Now, in this case, we deduct the shares surrendered by each old partner from their earlier share to determine their new ratio. And for determining the share of new partner, the shares surrendered by old partners will be added. Let us take an example. A and B are partners in a firm sharing profit in the ratio of 3:2. They admitted C as a new partner for 1/5 share in the profits. C acquired his share from A and B in the ratio of 2:1. Calculate the new profit sharing ratio. Now, A and B sacrifices in a particular ratio given in the question, that is 2:1. A sacrifices 2/3 of 1 by 5th, that is 2 by 15th, and A's remaining share is calculated by deducting 2 by 15th from A's old share. And if we deduct 2 by 15 from 3 by 5, it comes out to be 7 by 15. Similarly, we will calculate B's remaining share, that will come 5 by 15, and for C's share we will add sacrifice of A and sacrifice made by B, that is 2 by 15 plus 1 by 15. C's share will come to be 3 by 15, and new profit sharing ratio will be 7:5:3. And now the third case is when new partner's share of profit is not given in the question, but the share which old partners sacrifice in favor of new partner is given. Now, in this case, the share that old partners render in favor of new partners is added to get the share of new partner. For example, A and B are partners in a firm sharing profits in the ratio of 1:2. They decide to admit C as a partner. A decides to sacrifice 1/5 of his share, and B decides to sacrifice 1/6 of his share in favor of C. Now calculate the new profit sharing ratio. In this case, A sacrifices 1/5 and B sacrifices 1/9 of their share in favor of C. A sacrifices 1/5 of 1/3, that is 1 by 15, and B sacrifices 1/6 of 2/3, that is 1 by 9. C's sacrifice will be 1 by 15 plus 1 by 9, that is 8 by 45, and new profit sharing ratio will be 12:25:8. Now the next case, the last case for calculating new profit sharing ratio is when new partners acquires his share of profit only from one of the old partners. In this case, the new profit sharing ratio is calculated after deducting the sacrifice made by the old partner from the existing share of profit. For example, P and Q were partners in a firm sharing profits in the ratio of 3 is to 2. They admitted R as a new partner for 1/5 share in the profits, which he acquired entirely from P. Calculate the new profit sharing ratio. Now, in this given question, P sacrifices 1/5 share in favor of R. So, 1/5 share sacrificed by P is deducted from the original share of P, that is 3 by 5th, and new profit sharing ratio comes to be 2 is to 2 is to 1. So students, this was all about calculation of new profit sharing ratio. In all the above cases, we can also calculate the sacrificing ratio by deducting the new ratio of the profit or loss of the each partner from their old share. Now, after new profit sharing ratio, the next topic is the revaluation of assets and liabilities and their accounting effects. In this topic, let us first understand the meaning of revaluation. Revaluation means valuing the assets and liabilities again according to the current realizable value. The revaluation of asset is done because it is necessary to give effect of revaluation in the books of accounts, as the change in value that occurs belong to the period when old partners were running the business, and hence its profit and loss should also be borne by the old partners in their old ratio. Now, partners may mutually decide about the methods of adjustment that they want to adopt. The first method is when the partners want to show the revised values in the books of accounts, and the second method is when the partners do not want to show the revised values in the books of accounts. Now, we study the first case, that is, when the revised values are to be recorded in the books of accounts. In this case, we prepare revaluation account, which is also known as profit and loss adjustment account. This is the nominal account where losses due to revaluation are debited and profits due to revaluation are credited. We can see here also all the losses due to revaluation, whether in form of decrease in value of assets, increase in value of liability, or unrecorded liability, are debited, and all the gains in form of increase in value of assets, decrease in value of liability, or unrecorded assets are credited. At last, we balance the account to find the net gain or loss at the time of revaluation, which is ultimately transferred to the capital account of old partners in their old ratio. This is the format of revaluation account. We have already discussed the items to be posted on the debit and credit side of this account. We can also pass the journal entries in case of revaluation. First, for increase in value of assets, particular asset account will be debited and revaluation account will be credited. And for decrease in value of liability, particular liability account will be debited and revaluation account will be credited. And the next and third entry is for a decrease in value of asset, revaluation account will be debited and that particular asset account will be credited. For an increase in value of a liability, revaluation account will be debited and that particular liability account will be credited. For an unrecorded asset, asset account will be debited and that unrecorded asset account will be credited. Next entry is for an unrecorded liability, revaluation account will be debited and that particular unrecorded liability account will be credited. For profits on revaluation, this profit will be transferred to old partners' capital account in their old profit sharing ratio, and the entry will be revaluation account will be debited to old partner's capital account. And similarly, for loss on revaluation, this loss will be transferred to old partner's capital account in the old profit sharing ratio. Old partner's capital account will be debited and revaluation account will be credited. The second case of revaluation may be when the partners decide not to record the revised values in the books of accounts. In this case, the memorandum revaluation account is prepared. And now let us see how we prepare memorandum revaluation account. This memorandum revaluation account has two parts. First part is similar to revaluation account, and in second part the entries passed in the first part are reversed and the profits in first part becomes the loss of the second part and loss of first part becomes the profit of the second part. This profit is credited to all partners, including the new one in the new profit sharing ratio, and if loss, that loss is debited to all partners in the new profit sharing ratio. In case of memorandum revaluation account, remember, no entries are passed in the assets, liabilities or capital account. Only one single adjustment entry will be passed. Now this is the format of memorandum revaluation account. The entries to be posted therein we have already discussed. Now, in the first case of revaluation, we prepared revaluation account, whereas in the second case we prepared memorandum revaluation account. Now, what is the difference between these two accounts? What is the difference between revaluation account and memorandum revaluation account? Let us see. First, there is a difference in the objective with which it is prepared. Revaluation account is prepared to know the effect of revaluation of assets and liabilities on the old partner's capital account only, whereas memorandum revaluation account is prepared to know the net effect of revaluation on the capital of old as well as new partners. This second difference is that revaluation account is prepared when the partners intend to show the revised values of assets and liabilities in the books of accounts, whereas memorandum revaluation account is prepared when partners do not want to show the altered values of assets and liabilities in the books of accounts. The third difference is that in revaluation account, figures are shown in balance sheet at the revised values, whereas in memorandum revaluation account, the assets and liabilities are shown in the balance sheet at their original values. Next, the revaluation account has only one part, whereas memorandum revaluation account is divided into two parts. And the last difference is that in case of revaluation account, the balancing figure, that is profit and loss, is transferred to old partners capital account in their old profit sharing ratio, whereas in memorandum revaluation account the balancing figure, whether profit or loss of the first part, is transferred to old partners in their old profit sharing ratio, whereas the balance of second part is transferred to all partners in their new ratio. So students, this was about the effect of revaluation and its treatment in the books of accounts, and we will be discussing the accounting treatment of remaining topics in the upcoming videos. Thank you and stay connected.